Hi, welcome back everybody. I thought today we'll talk about this video which me and Anand saw on YouTube with Warren Buffett and Charlie Munger, where he talks about the returns of hedge funds versus index funds. I think Anand should bring us to the topic.
Yeah. So I've been always talking about not only hedge funds, about even mutual funds. So there are two classes of mutual funds, active mutual funds and passive mutual funds. And always I have been saying that passive funds over a long term will trump
Active funds.
active funds.
But let's just first let people know what is the difference between an active and a passive.
An active fund needs a fund manager. So who will do stock picking,
Who will
actively manage the stock for you, portfolio for you. A passive fund is a fund which does not require any.
It runs on autopilot.
It runs on autopilot. So you say that what you want to buy, that is Nifty, suppose, or the S&P 500. So the same way the S&P 500 adjusts its market capitalization,
Correct.
this will also adjust and it will reflect exactly the S&P 500.
Correct.
If there is any difference between the S&P 500 and this fund, it's called a tracking error. So a fund with low tracking error, every fund will have a minor tracking error. A fund with a low tracking error, we should be able to manage. Vanguard S&P 500 is a great example of such a fund which is low cost. The dividends that are paid out are again comes into the company and are reinvested. There's an index called a total returns index. What you see is normal index. A total returns index is index plus what is the dividend paid out and added. Time after time it has been shown that even in US Morningstar, more than 85% of active funds trail passive funds. Correct. So it's very difficult to say which fund will beat the index. So you will have to find an advisor to tell you which fund will beat the advisor. If you do not know anything about stock markets, or you don't have a guide who will tell you at a very low cost what is going to happen in the market, it is going to be a joke. You will lose money.
Correct.
And so what happened in 2008, at the height of the market, is that a group of hedge fund managers called Protege Partners challenged Warren Buffett, because Warren Buffett had kept on saying that no active
fund can beat
a passive fund.
Yes.
These guys challenged him. Buffett accepted the challenge in 2008.
Took the bet.
The S&P fund fell 37% in the first year. The funds chosen by these guys fell only by 20%. Both lost money. But then on, when they closed the bet 8 years, the bet was supposed to run for 10 years. On the 8th year when this video was made, correct, and they closed the bet successfully.
Correct.
The S&P fund was up 65%, whereas this fund was only up 21%.
Correct.
So therefore, and they conceded defeat at that point.
Correct.
And they agreed to give $1 million to charity.
Correct.
And he chose his first wife's favorite charity to donate that money. The Glide Church got $1 million.
Correct.
So the bet was, you will put $500,000. They will put $500,000. The money will go to the Glide Church. Halfway down the point, the hedge fund realized that buying Berkshire stock would be better.
Correct.
And they bought Berkshire Hathaway. And finally, when the bet was closed, $1.3 million got accumulated into the account and it went to charity instead of $1 million. But the message is very clear that it cannot. In the case of the hedge fund, there is a 2 and 20 rule. 2% for a management fee plus 20% of the profits. So that means you will never beat the index.
True.
With that, in case of active funds, the management fee is 3%. And in passive fund, it is less than 0.25. It can be run by 0.15.
And the difference is huge.
The difference, that looks very small
now.
In
terms of percentage. Yeah.
Yes, but when you compound over 20 years, it becomes a very big difference. So you can make a $500,000, $100,000, $1 million to your nest egg. And that is why he says, for my wife also, after I die, her money will be put in Index funds only. So this is the way to structure a deal. Now the next question. If everybody buys an index fund,
correct,
it becomes a bubble. That's what
index bubble.
Index bubble. Yes, the index will go into a bubble. It will correct deeply. Because what price you are is
A lot of
what
money is chasing the
same thing. So it was at 4,500, the S&P 500. It's come down to 39. It may fall to 3,000. But the point being, you are overvalued then and you are undervalued today. And that is why Buffett says and others say, you don't just, you keep on dollar cost averaging. That is, dollar cost averaging is the word for sip.
correct
You,
sipping.
you keep on sipping.
You don't try to do a lump sum investment.
You
What you
do a
do is,
lump sum investment.
you do drops at a time.
You do drops at a time. Then who are the people who really make money in the stock market by stock picking? For this, you need to have special skills,
Correct.
not in terms of intelligence, in terms of patience, that you can wait forever and for the right moment to come with money, and then you can enter and buy. And then you should be willing to buy amounts of money that you can afford to lose.
Correct. To
That
see
is
those
it.
kinds of gains.
Yeah, that is, you need not, it doesn't. What I buy, if my stock portfolio becomes zero, it won't hurt me tomorrow.
True.
It's not going to change my lifestyle.
True. I remember you telling me that you and Dad, when the initial IPO started way back in the 90s, that you bet on some 20, 30 companies, including companies like
Yeah.
Infosys, out of which 6 would turn into stellar companies like Infosys. Quite a few of them disappeared. And you said, but the dawn law of averages, if you see, the money which you made in Infosys
Yes. At
recovered.
that time, India did not have the kind of knowledge bank that we have today.
Correct.
So, out of 20, if I pick now, 12 or 13 will be big hits. And those 13 big hits will take care of my losses on server.
Yeah.
But the other point I'm making is the amount of stocks I buy, you know how I buy.
Yes.
I buy only what I can afford to lose.
Correct.
And over a period of time, I have bought only what I can afford to lose.
Correct.
So, in my mind, there is no portfolio sitting there for me to draw.
Correct.
So, my mind is free.
True.
So, I buy only what I can
Afford to lose.
afford to lose.
True.
So, you keep on putting money what you can afford to lose. You don't try to maximize your gains.
True.
I can afford 5,000 rupees today. I can afford $5,000. I'll buy $5,000.
So this advice is mainly for people who are very young, who have a long timeline ahead of them, who, because they don't make much money right now, it just takes a small fraction of their salary. just
Yes,
to sip.
and keep sipping in the index.
Correct.
And if you don't know anything about the market and you are in your mid 30s, you continue to sip in the market.
Correct.
This is not for people who are going to retire in next 5-10 years.
Yes, it doesn't work for them.
It doesn't work for them.
It's too late.
It's too late. See, for this to survive, the length of runway has to be large. The return, and you have to be in the right economic cycle. So the world has gone through a long bull market from 1980s till now. That's nearly a 25-year bull market. And there's also been a 25-year bond bull market. And both in bonds and in stocks, the central banks have actively contributed to make these profits.
Correct.
So we don't know what will happen in the next 20 years.
True.
Yeah, that's the problem.
Yes. This is an interesting conversation about active funds and passive funds and the advice he's giving to young people going forward.
Yeah.
Thanks, Anand.
Thank you. Thank you for watching Be Rich. If you like this content, kindly hit the subscribe button and turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put out a video. Once again, I thank you for supporting Be Rich.